Hello everyone, Dan Michalk here. Just wanted to bring you a quick update on what's happening in the markets, what we're seeing, what we're doing. During periods of geopolitical conflict like we're dealing with in Iran, we like to over-communicate and give you a little more insight into what we are thinking. So first off, we're 50 days in. I want to pull up a chart you saw during our last video. 50 days in, these conflicts typically last about 60 days. So I would expect this to continue for a while longer. The strait is closed, so we're surprised oil is still in the $90 to $100 barrel range. If you would have asked me earlier this year, I would not be surprised to see $120 to $150 oil with the strait closed. But we are 50 days in, and as you can see by the chart, we're tracking a similar pattern. We would hope that playbook would play out, but in this type of environment, you don't want to count on it. It could last longer, which will have some impact on growth for us. Second item I want to talk about is the market resilience. I want to pull up a chart here. So we went down during this period about 9%. Typical correction when oil spikes 100% is you get a 20% drawdown. So we have not seen anywhere near the drawdown we would have expected. And then this rally over the last 2 weeks, we've gone back up 10. And actually today, we've set a new all-time high on the S&P. So the market has been very resilient. And I think what's changed is the market pivoted from will something happen, and the market now is expecting things to happen, which could be a problem if this drags on longer. So we're watching that very carefully. And then I'd say the next thing is oil. Anytime you get these shocks, it slows economic growth. I have a chart on this over 4 different scenarios in the past. And as oil spikes, you can see the bars of economic growth have suffered. So we expect some slowdown. We're not calling for a base case of a recession, but we do think it will hurt economic growth if oil stays in this $90 to $100 barrel range. So not wanting that, but that's the reality of where we are. And then last piece I want to talk a little bit about is high yield spreads. So high yield spreads are the difference between treasuries and what high yield companies or junk bonds are paying. Today, spreads are very low, meaning their bond market is not foreshadowing a correction, a recession. Usually it's a leading indicator. And if you would have told me we would have this blockade in the strait, you'd have $90 oil, I would not have believed spreads would be as tight as they are. They're running about 270 basis points. Typically that would spike to 500 or 600. So that's not foreshadowing a major slowdown, which to us gives us reason to pause. But those are the things we're watching right now. What we're doing in the first quarter, we did take advantage and we added some duration to the bond portfolio. When the 10-year spiked to about 4.4%, we added some bond exposure there to pick up a little bit of yield. We did execute on some tax loss harvesting. As stocks sold off, we captured some losses and reinvested that. And then the third thing, we did lean into growth. Growth has sold off since October of last year. The Magnificent Seven have not been so magnificent. So we took advantage of that and we leaned into a little bit of growth. But as we go forward into the summer, if this market continues, we'll trim back on equities. We don't want to be too overweighted as we go into the fall and midterms. Also at the same time, if there isn't a deal, then I could see us leaning into equities if we did see the market pull back 10, maybe even 20%. So at this point, we have to stay flexible. And if you're concerned about your portfolio, we welcome a call, happy to have a conversation or meeting. And then also we'll update your plan too, because we want to make sure that you have the confidence to live and not worry, because that's what we're here to do. So thank you. Look forward to seeing you soon.